folks, hope you're well and welcome back to the Risk Management Education Series. In the first three sessions we looked at the numbers behind risk, how that factors into building and executing our edge, and how to build a risk management plan. And in the last session we started looking at the tools that we have at our disposal to implement that plan consistently by talking about the stop loss. Today we'll continue that theme by looking at position sizing. If you haven't watched the previous sessions, I'll link them on screen and I'd recommend going back to watch them, as I will reference some of the concepts in this session. But like the stop loss session, I'll try and make this work as a standalone video as well, where you get the premise of position sizing and why it's so important. So my experience of position sizing is something that people, and particularly new traders, don't put enough emphasis on, either in learning at all or implementing consistently across their series of trades. And that word consistently is something that I've mentioned a lot in this series, and it's certainly, in my view, the key to longevity within markets. Executing the same things in the same way over and over is what makes us profitable over time. And there's a pretty famous quote from Bruce Lee that I'm sure you've all heard a million times before: I fear not the man who's practiced 10,000 kicks once, but I fear the man who's practiced one kick 10,000 times. And the message he was trying to convey in that is essentially the same, that consistency is the key to excellence in any discipline, and the same applies to us in terms of trading for the same reasons. A lot of traders position size randomly with little thought behind the reasons why they're going in with that position size, and if you add into that, arbitrary stops that we've spoken about already, no stop at all, random strategies with no clear rules or no risk plan. And what you're essentially building there in your trading is 10,000 individual trades traded once, rather than one trade traded 10,000 times. And that's very much the kind of message in terms of that consistency there. So in this session, our goals are to try and understand what do I mean by consistent position sizing and why we'd want to apply that to implement our edge, how the maths works for that position sizing, how to apply that knowledge through a couple of examples just to show you how it works. And then we'll talk a little bit about something that a lot of people miss in terms of the consistency of implementing position sizing, some of the variables that often don't get accounted for, and why in particular, if you're a scalper or an intraday trader, if you don't account for all those variables, you can end up snatching defeat from the jaws of victory in every trade, so to speak, by having a plan that you think is profitable, but by not accounting for all the variables, it ends up not being profitable over time. The first thing we'll look at then is what position sizing is and where it fits within our overall edge, how that part of our risk management plan helps us to, over the series of trades, be profitable. And the first bullet point in there, I've said a number of times in this series so far that one of the biggest mistakes that new or consistently losing traders make is assigning too much importance to any individual trade and the outcome of that individual trade. We really have to be comfortable as traders that the outcome of any individual trade is irrelevant within the series of trades that it's part of. The only thing that matters in any of those individual trades is that you executed your rules and followed your risk management plan. So your checklist really should be as simple as, did you do all the things that you were supposed to do? Yes. Well, that was a well executed trade. Move on. The result of the single trade doesn't matter at all. And that can be quite a counterintuitive thought, that the result of individual trades don't matter. And I get asked often, if you don't care about the result of an individual trade in terms of whether that's profit or loss, how can you possibly be profitable over time? And the answer to that comes with trusting your system, trusting your data, and trusting how you execute that consistently over time is what's going to be profitable for you. So it doesn't matter because we've back tested and forward tested our strategy. We know the win rate of it. We know, for example, that it only wins 54% of the time. And if we know that it only wins 54% of the time, then conversely we know that it loses 46% of the time. But that's cool, because with consistent risk management and application of the rules that we've defined in that strategy, the average win that was returned in testing was, for example, 2.43R. So if we're returning 2.43R within that 54% of wins for every 1R that we lose in the 46% of losses, then when we apply that consistently over a series of 100 trades, for example, that's going to be a profitable strategy, and that's all that really matters, is how profitable you are over the series of trades. So let's take 100 trades just as an example. That gives you 56 winners with an average return of 131.22R versus 46R worth of losers for an overall P&L of 85R over the series of 100 trades. So that's just basic maths in a really simple 100 trade series there. So if your risk is 2% account and you've applied that consistently, as I've spoken about, then congratulations. With a 56% win rate, you made 170% of your account over the 100 trade series, not including any compounding or anything on top of that. And that really simple maths is really the story of it. If you look at the series of trades, if you look at how many trades you do over, for example, a year, you're never going to win them all. There are going to be losers, you're going to be wrong. All you have to do is make sure that your maths works in terms of your system, your back-tested results, what you back-tested and forward-tested is actually being delivered from the market within your execution, within your application, and over time you will be profitable. You don't need to care about any of the individual trades in that. You don't need to care about taking huge risk in any individual trade, because quite simply, trading isn't a get-rich-quick scheme, and if that's the way that you think of it, then it very quickly becomes a get-wrecked-quick scheme rather than a get-rich-quick scheme. Consistency over the series of trades is what really makes us profitable. And as you can see for that example, the key is being consistent to your rules. And I go back to that quote from before, one trade 10,000 times, not 10,000 different trades traded once. If every trade is different in terms of what you're trying to execute, then you're putting all your eggs in that single trades basket, and you don't get the benefits of what can be delivered over a series of trades by being consistent to your rules, your risk management, your position sizing, your stop loss plans, all that good return or positive return that you get from that consistency you don't get because you're never doing the same thing more than once. It's only one thing multiple times. And position sizing then is how we bridge the gap essentially between the individual trade and the series of trades, and it's a bit of a difficult concept sometimes for people to get their head around about what I mean by that, but as we spoke about in the last session, stop losses are individual to each trade in the sense that they're based on the technicals of that trade, and every trade will have different technicals. Not all charts are the same. The rules will always be the same, but how the chart presents those setups is going to be different on each individual trade. So your rules may say, just for example, that in a simple strategy, your stop goes 5 ticks below the last swing low if you're taking a long trade. And in trade A, that might be 0.5% from your entry point, but in trade B, that might be 4% from your entry point, because it depends on the price action, the time frame that you're trading, the chart on that given day, and it's never identical in terms of the price action. So your rules have been followed, but the gap between your entry and your stop is different. So the first risk that you manage is the trade risk. That's the difference between your entry and the stop. Where is the appropriate place for that stop to be in the individual trade? Where do we base our risk off? But then we need to make that trade risk equal to our max account risk that's defined in a risk management plan, and make that equal to that max risk in every trade, so that over the series of trades the risk is consistent, and as a result of that consistency, the winners are always a factor larger than the risk at an account level. And position sizing is how we achieve that. It turns individual trade risk into our max account risk in every single trade, so that every trade carries the same capital risk, and we know if we're looking for 2R or 2.5R or whatever it is we're looking for in that, then the profit becomes consistent over the series of trades as well. It means our losses at an account level remain expected, as we spoke about in the last session. We want to make sure we know what to expect with our losses, and it ensures that our profit factor is always a larger factor than the risk in any individual trade across that series. Let's jump into the maths then. We'll have a look at the calculation, the variables that are required, and then we'll jump quickly into a couple of examples, because that makes it easier to understand, I think. So, in terms of the variables that you need for this, you obviously need your account size, which is going to change based on every winner and loser. So that's another kind of point to make about this as a process, is that it remains scalable because we work in percent size against the account. So account size is the first variable. The second variable is the max account risk per trade, and that's the percentage that I would normally recommend you use, and that comes from your risk management plan that we discussed a few sessions ago. Your max trade risk then becomes your account size multiplied by that max account risk per trade percentage, and that gives you the amount of dollars that you're able to lose, or pounds, or whatever your currency is within that individual trade. Your entry price for the trade idea following your rules, the stop price for the trade idea following your rules, and then from that you can calculate the risk premium per unit. So in a long trade, the risk premium per unit is your entry minus your stop, and in a short trade it's your stop minus your entry. So that essentially just tells you what your dollar or pounds or whatever your currency risk is per unit that you buy on that position. And then from those variables, your position size becomes that max trade risk that we calculated based on the account and the max percent of your account you're able to lose, divided by the risk premium per unit. That tells you how many units to buy of any individual asset, be that a stock or an indices or a crypto or whatever it is you're looking at. And that's it. It's pretty simple in terms of the maths. It's just something that I think a lot of people are not aware of or don't apply the logic. And if we take it a step further, and we'll go into this in more detail in the leverage session, but in terms of responsible use of leverage, or what I deem to be responsible use of leverage, that would be in situations where your individual trade risk is lesser than your max account risk per trade within your risk management plan. That allows you to then use leverage to size that trade up so that it meets your max risk. So where leverage is required, your dollar amount of the position size, which is obviously the unit position size multiplied by the entry price, divided by your account size, and that will tell you how much leverage you need to stay within your risk parameters. As I say, it can sound a bit more complicated than it actually is when you see the variables and then the formula laid out there, but we'll run through it in a couple of examples just to show you that it's actually pretty straightforward. The first example then is a sizing down example, and this generally applies to higher time frame trades. It's more of a kind of swing trade or position trading tool because the risk tends to be a bit wider in those. Your rules can be exactly the same on a swing trade as they could be on an intraday trade, for example. Price is fractal, so you may see the same setups on the 4 hour or the daily chart as you see on a 5 minute and a 15-minute chart. But whether you're sizing up or sizing down, depending on the type of trade, the formula and the variables and the maths of it always stays the same. So it's just a single process. You don't need to worry about managing two separate processes. So I won't go into the details of the trade in terms of the trade strategy. Let's just assume for this that the trade follows all the strategy rules. And the stop location within this strategy is deemed to be the previous swing low before entry. So in this example, we'll use a fictional account of $10,000, and we'll use our max account risk per trade at 2%, which is what we've been talking about within the sessions. So that makes our max trade risk for any individual trade $10,000 times 2% is $200. So that's what we can risk in the trade. Now that doesn't mean that's what our position size is. That just means that's the risk. So we can go in with far more capital than that, but our stop loss limits us to losing $200 worth of that capital. So the entry price on this trade then is $18,937, and the stop price was $18,455.50. So a 2.54% trade risk. So you can see there this risk is larger than our acceptable or max acceptable risk against our account. So the risk premium per unit then is the entry minus the stop, which gives us a $481.50 risk premium per unit. And we know that we're allowed to lose a maximum of $200 per trade, and the risk premium is $481.50. So we divide that $481.50 by 200, and that tells us that we can buy 0.415 units in this scenario. So this was a Bitcoin trade, but the same would apply if it was an Apple stock, or if it was a Forex pair you were trading. It's exactly the same rules apply. So 0.415 units, an entry of 18,937 as a position size of $7,858.86, so 78% of our available capital. So you can see that that's a sizing down trade. We're not going in fully, but these numbers give us a full size trade at 2% account risk with an individual trade risk of 2.54%, and the risk return or risk reward in this one was 2.23. So the winning trade gave us a return of $446 against that $200 risk, or 4.46% on account for this trade. So hopefully that makes it kind of make a wee bit more sense and come to life when you see it on a chart, how you do the maths to work out your position size to turn your trade risk into your account risk. Let's have a look at the second example then, which is an example of sizing up. So that trade, the trade risk was larger than our max account risk per trade, but this one we'll have a look at one that's smaller. So this is Bitcoin again. It's from a 5-minute chart this time, where these tend to be a little bit more prevalent. So the sizing up tends to be for lower time frame trades, either intraday or scalp. But again, the math stays the same. So again, fictional $10,000 account, max account risk per trade 2%. So the same max dollar amount is available to us here, which is $200. In this trade, the entry price was 19,299.5 and the stop price 19,153.5, so 0.76% trade risk. That gives us a risk premium per unit of $146. So again, we divide the max allowable loss by the risk premium per unit. It gives us a unit position size of 1.36 units. And 1.36 units at an entry of 19,299.50 is a position size of $26,247.32, so roughly 262% of our available capital. So obviously in this scenario, leverage would be required to size us up to a maximum risk trade. And the way we calculate that leverage, if your exchange requires you to calculate it manually, which most do, is $26,247.32, so the overall dollar position size, divided by your account, $10,000, which gives you a 2.62x leverage factor. And if you use 2.62x, that'll give you a full size trade at 2% account risk with an individual trade risk of 0.76%. The RR is similar to the first example, which is 2.16, but it ensures you get a return of $432 or 4.32% account on this trade as a winning trade. So there's two examples then, one on a higher time frame chart with a higher risk, and a second on a lower time frame chart with a lower risk. But the maths allows us to turn those individual trade risks into a consistent account-based risk, regardless of the individual parameters of that trade. And that allows us to be consistent over the series of trade, and it allows us to take many different types of trade over a series of trade. You might have one that's open for a few weeks as a swing trade, or you might have one that's open for a few hours as an intraday trade, but the risk in them against your capital and your account is the same, and your return on those against the capital on your account is the same, depending on what the individual risk reward is within the trade, but the expected return from your system can remain the same as well. So we can build that account slowly over time, trade by trade by trade. And because the position sizing allows us to be consistent within how we build the trade, it means that the individual trades, as I said in the first slide, remain irrelevant, because you're never going to lose more on one trade than you are on another. You lose the same in every trade, regardless of whether it's a 5-minute chart or it's a 4-hour chart. So you can disregard the profit and loss of each trade as an individual trade and just add it to your journal as part of your series, knowing that after 100 trades you expect to have made profit because of how that tested and how it's performed since you started trading it live. So hopefully that makes sense from a maths perspective. We've looked there then at the basics of position sizing, how the maths works and how you apply that maths to either size up or size down your individual trades to make each individual trade a consistent account-based risk across your series of trades, and we do that for consistency of return, consistency of risk management, and so that we can look at the outcome of that series of trades. Before we finish up today, I want to look at something that I think most people tend to forget when we're looking at position size, and certainly of the videos on YouTube that I watched when I was trying to learn this myself, or the textbooks or the articles that you can find online, they tend to miss out the fee element of it. And the fee element, it can be minimal on trades where you're sizing down. So like the first example there, when we had the swing trade that was a larger risk than our max allowable risk, and you're sizing that down for spot trades, which that really is just a spot trade, the fees are kind of minimal there, so they don't add a huge amount to your risk, and they don't remove a huge amount from your reward in terms of percentage against your account anyway, unless you've got a particularly huge account. But in leverage trades, and if you're a scalp trader or an intraday trader, where most of your trades are taken with leverage, if your leverage starts to get high, then that can add a huge amount in terms of fees to your overall trade. it can increase the risk exponentially, even if you think you're within your risk parameter, because of the way that the fees work against the dollar amount of the position size. And on a lot of occasions, they can kind of make what appear on paper to be winning trades actually losing trades when you look at the fee impact on it, particularly on smaller accounts. So you consider, for example, if you're a scalp trader who finds a successful system and a lot of your trades have a trade risk of 0.05%, for example. If your max account risk is 2%, then following the position size and maths, then you would be using 40x leverage essentially to size that trade up to max risk. So if you're on a $10,000 account and you're sizing that up by 40x, I think we can all do that maths. That's a huge position, and the fees on that are likely on their own to take a huge chunk out of your profit in a successful trade, but they're also likely to double or more your actual risk within the trade there. So although you think you're 2% risk, that could actually be 3, 4, 5% risk on that trade once you include the fees. So yeah, on smaller accounts in particular, it can be a problem, and they can eat all your profit and multiply your losses, and it's something that can be quite hidden within the trading system. It's a way that exchanges make money. Even when you think you're winning, they're actually winning, because the fees kill your profitability over the series of trade if you don't account for them. So how would you get around this then? And I think the only way you can really get around it is to size the positions to include the fees, and that's when you're taking leverage, you could be a little bit flexible about it and just say you're never going to take the full amount of leverage. You're always going to leave an X or two out, based on what the position sizing tells you. You're going to leave an X or two out to cover the fees and make sure that those fee adjusted risk parameters don't exceed your maximum risk per trade. Or you can actively size your positions based on what the fees are going to be. So most exchanges will publish what their fee rates are for maker and taker fees, and you can work them into the maths in terms of how you work at your position size. Now, the math starts to get more complicated when you do that, so I'm not going to go through individually how that works just now, but what I will do is I'll show you an example of what I mean. I've got my own position sizing tools that I wrote for myself that I've just got on my website, so I'll show you the difference in terms of how a trade looks when you account for fees and the risk and when you don't account for fees and the risk, and it just highlights what I mean, I think, with this being a consideration that you really should make, particularly if you've got a smaller account. So let's have a look at the examples, and hopefully it makes more sense. Let's have a look then at how the trades would look in terms of a position size. So this is the first trade that we looked at there, so the sizing down version. So it's the same entry price, stop price and target price as was in that trade. The fee details at the bottom here. This is a fairly common crypto exchange fee rate, so 0.01% for maker fees and 0.06% for taker fees. So maker fees, for anyone who's not aware, are the limit order fees, and taker fees are the market order fees. So the planned orders that I usually go for is a limit in, a limit profit and a market stop. That's my kind of default for the order. So I want price to come to me when I'm trying to get in based on my setup. I want the profit to be triggered once price gets to a certain point, and I want to just get out as quickly as possible once my stop is triggered. So a market stop is what I prefer for that. So in terms of this then, the position size, you can see it does the same maths that we just did before. So 2.54%, $481.50 as a risk premium per unit. Which is, and our max is 2%. I've gone for $1,000 account here because I want to show you the impact on smaller accounts for this one. So it's $20 max risk per trade as opposed to the $200 and the $10,000 account. And you can see here it works out the same number. So it works out our RR, our profit, our stop out loss, and so on. Tells us how many units to buy and so forth. Now at the bottom here we can see the fee impact of this. So the entry fee, which is the number of units at entry price, so the overall cost multiplied by the maker fee there. We've got a profit fee underneath, and we've got the stop out fee. Now, all I want to concentrate on here is the entry fee and the stop out fee, because that's what essentially makes up your risk. We've got the risk premium, which is the difference between entry and stop. But over and above that, we've also got the cost that it takes for us to get into the trade, and the cost that it takes for us to get out of the trade at that exit price. I'll assume there's no slippage in this. You do have to deal with slippage sometimes as well if the market's running away. But for this example, we'll ignore the slippage issue. So you can see at the bottom there, the total loss fee is only 54 cents in this one. So when your risk premium per unit on a swing trade like this is $481, you're not going to be too fussed about the 54 cents that's getting added there on a spot trade with no leverage required. It adds a little bit, but it doesn't add a huge amount. And that was the point I was trying to make previously. But if we look then at the actual fee impact, or if you want to size that based on fees, the calculator will factor it in for you, and it just reduces your units down a little bit. It calculates your fee adjusted risk premium by adding in the fees, and tells you how many to buy. So just make sure that you're at 2% based on the fees as well. So that's what the calculator does. But as I say, for that size of trade, it doesn't make a huge difference. So the next thing I want to look at then is how that looks on a scalp trade, because this is where the issues come from. Just for completeness, then we'll look at the other example that we gave of a sizing up trade here. So this is the same figures that we had in the example 2 on the slides earlier on. And even here, where we can see it's not really a scalp trade as such. It's definitely an intraday trade with a 0.76% level of risk. That would be fairly common for the intraday levels, maybe even high, you would say, for intraday. You can see that on this small account where your max risk is 2% and your max account risk per trade then is $20. The total loss fee that gets added by using 2.64x leverage, which is a fairly small amount, is $1.83, nearly $1.84, which again doesn't sound much, but when your maximum loss is $20, you've added nearly 10% there to your potential loss on the trade. So it's not a huge amount, and you might be comfortable with that, but I think it's better to be comfortable with it from a place of understanding what it actually is, rather than ignoring it and wondering why you're a bit tight in terms of your RR later. And if I flip the size to include the risk in there in terms of the sizing, you can see it reduces the fees and it reduces the leverage required, but it also reduces your risk reward. And I think that's the kind of main decision you need to make in terms of how you want to factor the fees into your sizing. Would you rather accept that the fees are part of trading, as a lot of people do, and just accept that you're going to have those on top of whatever your win or loss rate is, or do you want to factor those into your maximum risk at 2% and just reduce the R in each individual trade? So this one here drops, as you can see, it's 1.96 R with the fees included in the sizing, so the fee adjusted size, versus 2.16. So it doesn't make a huge difference in terms of the R. And this is the method I prefer, is to include the fees in the risk. It just works better for me. It's just the way that I prefer. So that's the second example. I'm going to show you a scalp example now, because it's even more apparent in that, and it just kind of completes the examples here of why I'm bringing this up as an issue. So I've adjusted the stop price here and the target price just to make this more of a scalp trade. So 0.12% trade risk and a 2.1 R risk reward. So it's a fairly reasonable kind of number in terms of how you would look at scalp trades. And this is actually a trade that I see often in terms of the systems that I look at on the 5 and the 15 minute chart, which is a lot of the kind of intraday setups that I would be looking for. I even see some that are lower than this. I quite commonly see 0.08% or 0.09% in terms of trade risk. So as you can see here, similar numbers, the $20 in terms of the max account risk per trade from a dollar perspective. The fees, though, because of the leverage that are required, so we're at 16x leverage here to size this up to a full size 2% trade, so 0.833 units with a position size of $16,000 on a $1,000 account. The fees calculated against that overall position size give you a total loss fee once you've paid your market order fee and your limit order fee for getting in, is $11.24. So you've essentially added another 50% to your risk here. So you've gone from 2% account risk to just over 3% account risk within this trade. And if the majority of the trades that you take are scalp or intraday trades with this kind of level of risk, and you think you're managing against a 2% account, and that's how you've sized your system. You know, if you've done your back testing, your forward testing, and you, for example, have found something that you're comfortable with that's at 1 to 2 risk reward, it wins 40% of the time, but at 40% of the time you're profitable on a 2% strategy. I'm sure you're doing the maths in your head at the moment, but if you increase your risk from 2% to 3% or more in these trades, then that impacts on your risk reward. That risk reward then is actually, you know, you're making in this trade $42 for $20, you think, but it's actually $42 for $31. So your risk reward here is actually only 1.5 rather than the 2 that you were expecting, or the 2.1 that you were expecting. And if you've sized, as I say, on that kind of 40% win rate with a 1 to 2 risk reward has been profitable over time, then actually if you look at the maths of a 1.5 risk reward, then you need more than 40% to break even. This is what can confuse people about why they're not making money when you think their system should be profitable. It's because they've not included the fee in the fees in the calculations, particularly if you're scalp or intraday and using higher leverage amounts. You know, anything over 10%, the fees really do start to rack up. In terms of the fee adjusted for this, if this was me, I would look at it in that sort of vein. So I would size down on this one so that I was going in with a smaller amount of units, smaller position size, smaller leverage. My fees are actually included within that. So if you were to calculate the number of units there, how much you'd be losing in those number of units, and then add the fees, that would equal to 2% of my account. So it just kind of does the maths for me, so I don't need to worry too much about it. So it's just my preference on these higher leverage trades. It allows you to see that your risk reward is far lower. So, you know, and in this one you can see here, when adjusted for fees, this trade is actually only a 1 to 3R. I would skip it. It gives me a way to filter trades because I know that it's not returning enough for me. I want a 1 to 2 generally is what I'm looking for. So when I put the details into the sizer here, I know I can disregard this trade. Now if, for example, I was able to get a little bit more in terms of if this chart had given me something different for a profit target, let me do the maths on that again. Even fee adjusted there, that one is still a 3.96R, so I would have taken that, but still fee adjusted, still the same position size, which is the risk rewards fits my profile. So hopefully that kind of makes a point on how important the fees are, particularly when you're using leverage, and particularly when you're on a smaller account in terms of calculating what those fees would be. Have a think about it, have a play around with it, and see if it works for you, or maybe you've been trying to figure out why you're not making as much as you thought you would with the system. This might be your answer, so have a play with it and see if that's the reasons. So hopefully this session's made sense in terms of the position size. I know maths can be boring, and it's not the most glamorous of subjects when it comes to trading, but this, and my view is very much that trading is as much a big game of maths as it is a game of technical analysis, and you have to put them both together and be consistent with them over time in order to make money and be profitable. So hopefully that's coming through, and hopefully this has been useful. Until next time, stay safe. My tea's it. Gotta go.